Welcome to our deep dive on Scallop, one of the most intriguing money market protocols emerging from the SUI ecosystem. Today, we'll unpack everything, from the team's origin story to the real on-chain activity, developer momentum, token mechanics, revenue model, and future roadmap. We've pulled data from GitHub, DeFi Llama, and the official white paper, so you can decide if Scallop is more hype or high value. Let's start by looking into the people behind this project. Scallop was founded in early 2024 by a team of DeFi native builders. Their core contributors have backgrounds in Move smart contracts, SBF-supported bootcamps, and Web3 protocols. Several members previously contributed to SUI Foundation infrastructure grants. That means they've been in the ecosystem from the start. On their LinkedIn, you'll find profiles like former smart contract engineers at leading DeFi firms and protocol auditors. They've released a formal blog and roadmap document, signaling early commitment. They won funding through a SUI Foundation grant in Q1 2024, a milestone that helped jumpstart liquidity mining programs and beta a minimum viable product by Q3 2024. The team describes their philosophy as secure, composable, and institutional grade, which we'll assess through code, contracts, and audits soon. Let's now explore their actual code-based activity. On GitHub, Scallop has 46 repositories, including their lending core, SDK, docs, and even a mini wallet project. Their core repo, Scallop Lending Protocol, shows consistent weekly commits, averaging around 6 a week. That translates to between 24 and 28 commits monthly, which is solid for a small team. We also noticed activity spikes around Q4 2024 and Q1 2025, correlating with new feature launches like the SDK and mini wallet. Counting unique commit authors, there appear to be between 2 and 4 active developers at any given time. That aligns with the roles defined in their token vesting schedule and grant disclosures. On-chain protocol updates are done via audited Move contracts, which are open source. So far, it's clear they're not just writing documentation. They're building and shipping core DeFi functionality. That level of development synergy gives us a good indication of execution-focused momentum. Let's move on to tokenomics and how the economics behind Scallop actually work. Scallop's native token, SCA, serves multiple functions: governance, staking to earn protocol fees, and economic alignment with borrowers and lenders. The total maximum supply is 1 billion SCA, with the distribution broken down as follows: 25% to strategic investors, 20% to the team, 30% to the community and ecosystem, and 25% to the foundation and partnerships. This structure balances funding needs with long-term decentralization. Currently, around 450 million SCA tokens are in circulation, about 45% of the total supply. The rest is locked under a quarterly unlock schedule, with approximately 5% released each quarter. This means inflation is moderate and predictable. As tokens unlock, they're expected to empower broader governance participation while introducing modest sell pressure. Staking SCA allows users to earn protocol fees with projected yields between 8 and 12% annually based on current volumes. The white paper focuses on 4 core pillars: over-collateralized lending, low-fee borrowing, an AMM aggregator, and a developer SDK. The lending model allows users to deposit major assets like SUI USDT or USDC and borrow against them at risk-managed collateralization ratios. Borrowing fees are kept intentionally low, around 0.25%. To attract capital from other ecosystems. The AMM aggregator routes liquidity across DEX on SUI, ensuring the best rates for users by leveraging deep liquidity. On the developer side, Scallop provides an SDK that allows developers to build DeFi apps directly on top of their protocol, a move aimed at composability and long-term growth. Security is another focal point in the white paper. The protocol has been audited by a third-party firm and addresses common DeFi attack vectors like reentrancy, price oracle manipulation, and insufficient collateral logic. Governance is handled fully on-chain. Token holders stake SCA to vote on proposals, with upgrades handled via proxy smart contracts. Let's talk numbers. According to DeFi Llama, Scallop currently manages around $90 million in total value locked. That TVL is fully on the SUI blockchain and has grown modestly over the past 30 days, from about 88 million to just over 92 million. This indicates steady capital inflows despite a generally volatile market. The protocol's borrow-to-supply ratio is around 50%, meaning half of all deposited assets are actively borrowed, a healthy sign for capital utilization. Cumulative protocol fees since launch have reached about $14.5 million. Annualized revenue is currently around $4.8 million. That's what goes back to stakers and the protocol treasury. Breaking that down, most revenue comes from interest spreads, the difference between what borrowers pay and lenders earn. Some revenue also comes from swap fees and AMM integration. Monthly earnings hover between $400,000 to $450,000, which implies a path to sustainability if expenses are controlled. On-chain, you can verify this revenue flow by tracking their fee collector contracts and treasury wallet. Funds are distributed to staking pools, protocol development grants, and a small reserve. This transparent fee model strengthens user trust and reflects the DeFi ethos of verifiability. Regulatory risk is always a factor. Scallop currently operates entirely on-chain and doesn't interface with fiat or centralized custodians. That keeps them in a relatively safe regulatory position for now. However, as DeFi regulation evolves, especially in the US and EU, protocols like Scallop will need to adapt or limit access in certain jurisdictions. There's no public-facing legal entity listed yet, and no indications of KYC. While this helps with decentralization, it may pose hurdles for future institutional adoption. If Scallop intends to scale toward traditional finance users, they'll likely need legal clarity or entity registration. Let's examine their roadmap and what's coming next. According to their published roadmap, Scallop has hit nearly all of its major development milestones. In Q3 2024, they launched lending and liquidity mining. In Q4, they rolled out borrowing functionality and their base fee model. Q1 2025 brought the AMM aggregator and mini wallet. Both are live and integrated into the Sui DeFi stack. In Q2 2025, they launched a public beta for the SDK. It's now being used by at least 3 other protocols on Sui for custom integrations. Looking ahead, Q3 and Q4 are focused on cross-chain expansion, enhanced AMM features, and governance portal improvements. There are whispers of new institutional partnerships and potential bridge launches, though nothing confirmed at this stage. Behind the scenes, GitHub activity confirms ongoing work on cross-chain bridging modules and advanced liquidity routing. While there's no firm date for these next upgrades, active testnet deployments suggest that progress is steady. If these releases land on schedule, Scallop could extend its reach far beyond the Sui ecosystem. So, where does this leave us? Here's our verdict. The team is small, but experienced, and they've delivered everything on their roadmap so far. Development activity is consistent, with regular commits and several launched products. Tokenomics are thoughtfully designed, with balanced allocations, gradual unlocks, and the actual utility for staking and governance. Financially, the protocol is already generating meaningful revenue and appears sustainable at current scale. Risks include Sui dependency, token unlock dilution, and of course, regulatory shifts. But with a clear product roadmap, strong integration in the Sui ecosystem, and a working fee model, Scallop stands out as one of the more mature money markets in the space. That wraps up our deep dive. If you found this helpful, hit that like button, subscribe, and ring the bell for more crypto reviews, deep dives, and protocol breakdowns. Until next time, stay curious and stay decentralized.